Here is what 99% of mortgage lenders don't want you to know, and not knowing this can literally cost you thousands of dollars. My name is Ramos. I'm an independent mortgage broker based out of Washington State, and in this video, I'm going to share the secret to how all mortgage lenders decide their interest rates and fees, so that if you are shopping for a mortgage, you can make a better buying decision. And be sure to stay through the whole video, because towards the end, I'm going to share who is most at risk of losing money by not knowing this information. Now, as a consumer, you may think that the mortgage industry works like this. You shop around for a mortgage, that mortgage company lets you borrow money to buy a house, they charge you interest on the money that you're borrowing, you keep making payments to the mortgage company until your debt is repaid, and that's the end of it. Now, this is all somewhat true, but there's also other things going on behind the scenes that you may not know about that directly affects how much you pay for your mortgage. What most people don't know is that there is someone working alongside the mortgage lender who is ultimately dictating what your mortgage rate will be, and that person is an investor. You see, within the first 6 months of you closing on your loan, your mortgage will likely be sold to an investor. Now, that investor's appetite for your mortgage is ultimately what will have significant impact on your rate. Now, let me show you exactly what that means and how it affects your mortgage. So let's say you have an investor who has a bunch of money that they want to invest. They have a lot of different options on how they can grow that money, but typically the safest investments are something called bonds. A bond is just a type of loan that an investor can give to a large organization like a company or a government, where the investor has a guaranteed return. Now, most investors don't like to take on more risk than is necessary, so they like bonds because they have guaranteed returns. One of the more popular types of bonds among investors is one that is tied to mortgages, and I'll explain why. It's something called the U.S. Treasury bond, which is a bond backed by the U.S. government. At the time of this recording, the U.S. Treasury bond is trading at right around 4.5%, which is not too bad if you're an investor. But why is this investment so popular? Well, it's because of who is issuing the bond. It's the federal government of the daggum United States of America. Investors buying into these bonds have zero risk that they'll lose money on the deal, and in fact, there is a guaranteed return, so they will gladly buy these bonds. Now, in contrast, there are other bonds that carry a little more risk but promise higher returns. One of these bonds is called a mortgage-backed security, and this is just a bunch of mortgages that are packaged together as an investment, and the reason why these are more risky is because they rely entirely on people paying their mortgages for the investment to stay intact. So, for example, if there's a massive recession and a bunch of people lose their jobs and they stop paying their mortgages, the mortgage-backed security falls apart and the investor loses their money. This is exactly what happened in 2008, and that's why so many banks and hedge funds closed.
0.7% here, a loss of 37 points or so. Apple.
Red everywhere, essentially, down by 4-5%. The stock market is now down 21%.
Their investments crumbled because of people not paying their mortgages. Now, if instead the investor's money was invested into, let's say, a treasury bond, they wouldn't be worried about the housing collapse because it doesn't affect them at all. They just sit back and they collect their 4.5%. So if this investment is riskier, why would an investor choose this over a treasury bill? Well, like I alluded to earlier, the returns are much higher. Interest rates for a 30-year fixed mortgage are hovering right around 7%, which is 58% higher than a treasury bill. Mortgage rates are experiencing upward pressure from treasury bonds because, in a way, they're competing with treasury bonds for investment dollars. Ultimately, it has to make financial sense for the investor to choose the mortgage bond over the treasury bill. Now, the other thing that makes mortgage bonds attractive to investors is the quality of the bond. Now, if you've seen The Big Short, you'll know that the mortgage bonds in 2008 were full of something called subprime mortgages, which were essentially just mortgages taken on by people who couldn't afford the payment or they had a bad credit history. In contrast, the mortgages that are packaged into modern mortgage bonds are of much higher quality, and there are 3 government entities that we can thank for this. They are Fannie Mae, Freddie Mac, and Ginnie Mae. They play a pivotal role in the mortgage bond being a reliable investment. Their job is to set guidelines for what kind of mortgage can make it into the bond. For example, they set debt-to-income requirements, down payment requirements, and baseline credit scores as requirements for mortgages to be included in a bond. The reason why is that establishing these requirements better ensures the stability of the bond, and therefore the investors feel much more secure about buying into the bond. And if you think about it, wouldn't you feel more secure as an investor knowing that all mortgages in a bond are paid for by people who make a lot of money, don't take out too much debt, put down a lot of money, and have a high credit score? Okay, so if the investor is the one ultimately holding these mortgages, how are your interest rates and fees affected by all of this? Well, simply put, almost every mortgage company is selling the exact same product. We all do FHA, VA, conventional, and so on, and we all sell this loan back to the investor. What varies from lender to lender is the one thing that affects your interest rate: how much margin they make on every loan. Margin is simply the amount of money that the lender will get for originating the loan. The higher the margin, the higher your interest rate. Margins are determined by the cost of doing business for the lender. If a lender has higher overhead, then they will inevitably have higher rates. Now you can spot these lenders very easily. They have multiple layers of management, they run Super Bowl commercials, they take their executives to trips on tropical islands, they have massive marketing and fulfillment teams. These mortgage companies are called retail lenders, and frankly, they dominate the industry. While they are typically thousands of dollars more expensive in fees and higher in rates, they put a lot of resources into two critical business functions: marketing and sales. This enables them to become the most visible companies to the consumer. And there's a saying that is so true: visibility beats ability 100% of the time. Now, what most people don't know is that you have another mortgage option, one with lower rates and consumer-friendly margins because they operate with much less overhead. This is through something called the wholesale channel. These are not direct lenders, but instead they are brokers connecting banks and lenders with the consumer. Because banks and lenders don't have to manage the overhead of operating a business, they are happy to offer their loan products at a significant discount. Let's say you're a winemaker and you open up your own tasting room. If a customer comes in and wants to buy a bottle of wine, they're going to have to pay full price because you have business expenses. You have to pay an employee to ring them up. You have to pay rent. You have signage outside to draw people in. You have to pay for air conditioning in the building and so on. But if instead you sold your product to a distributor like Costco, you're happy to offer a bulk discount because you don't have to manage any of those additional costs. So when a customer walks into a Costco, they'll find your bottle of wine at a much cheaper rate than what they'll buy it for at your storefront. This is exactly how it works with mortgages. Higher costs means higher prices. Cards on the table, I'm an independent mortgage broker with C2 Financial. And this is exactly what sets brokers apart. We don't have the same amount of overhead as a retail lender, and ultimately we shop your loan to 100 different lenders to find great rates and terms for our clients, and these lenders are all competing for your business, and where there is competition, there's increased value to the consumer. Let me show you exactly how this works. Here you're seeing the software that we use to shop 100 lenders for our clients, and this is only for demonstration purposes only and is not an actual interest rate quote. We're being compliant. Now this scenario is for an FHA loan at a $500,000 purchase price, putting 3.5% down, 690 credit score for a first-time home buyer in King County. So when I click submit, it's going to bring up all of the lenders that are wanting to fund this loan. Now if I click on one of these lenders, it's going to show that rates go from 5.75% all the way up to 7.625%. So what we see here in the discount/rebate column is how much money the lender is going to pay me if I originate this loan at a given interest rate. So if we originate it at 5.75%, the lender is going to pay me a whopping $231. I will try not to spend that all in one place. Now at the other end of the spectrum, we see at 7.625%, the lender is going to pay me $17,399. Not too bad. Now what I want you to see here is that the higher the interest rate, the more money the lender is willing to pay me. Now remember, this mortgage is an investment for an investor to purchase. So if he can get a higher interest rate, he's more willing to pay more money if the client agrees to take the higher rate. Now, when we're looking at retail mortgage companies, they often set their compensation at the higher end. So that means they'd be somewhere in the 6.625% all the way up to, let's say, 7.5%. Now, as independent mortgage brokers, we have agreements in place where our compensation is set to a flat 1.5% across all loans. So if we look at the rate sheet here, we would be somewhere in the 6.25% range. Now, the takeaway here is that the higher the interest rate, the more money the lender stands to make, so they're actually incentivized to offer you higher interest rates. And that is not true for most independent mortgage brokers who are set at a flat compensation percentage. So I mentioned at the beginning of the video that there are buyers that are more likely to save thousands of dollars by knowing this information, so who are they? Well, a lot of retail lenders will make even more money on certain types of loans called government-backed loans. That's FHA, VA, and USDA loans. I spoke to a branch manager of a direct lender a few weeks back, and they told me that on these loan types, they make as much as 4 to 5% on the transaction. On a $500,000 loan, that's upwards of $20,000. Now think about who is using these loans. These are first-time homebuyers with lower credit scores, military men and women who served our country, people who live in rural areas where incomes are much lower. These lenders are selling an inferior product that is costing these people thousands of dollars they don't need to spend. Now, I spoke to another lender who charged a VA client almost $7,000 in unnecessary fees, and all they got was an above market interest rate. Now, this is a veteran client who sacrificed years of their life to earn their VA benefit. They deserve better than what these lenders can offer. Okay, so all of this is great information, but what should we do with all this info? So here's the call to action. If you're a realtor watching this video, you need to have a broker in your tool belt. And think about this. Is your lender helping you create a referable experience? Are they providing a winning combination of speed, service, and price? If you care about your clients getting a great deal on their property purchase, why wouldn't you care that they get a great deal on their mortgage? Excellent service, great communication, all that is par for the course if you're a loan officer. But if your loan officer can't offer great rates because they have too much bloat in their business, then maybe it's time to consider working with a broker. After all, happy clients are clients that refer business. And what we found is that clients that are treated well and help you save money are happier clients, which means more referrals for you. If you're in Washington State, I would love to chat with you and see if a partnership makes sense. If you're a home buyer shopping for a mortgage, sure, talk to multiple lenders, but make sure that one of those lenders is a mortgage broker. You worked really hard for your money. Don't throw it down the drain by going to an overpriced lender. Have a few conversations and see who ultimately has the best combination of price, service, and reputation. So what do you guys think? I'm certainly open to a conversation about the industry, so if you completely disagree with me, let me know in the comments section. I promise I'm going to respond even if you're just trolling me. I would love to have a conversation with you. I'm going to be making more videos on all things mortgage and real estate, so if you like this video, please like it for the YouTube algorithm. Subscribe if you found this helpful. It would mean the world to me. Love you. Bye.